Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, US labor market really improved on the November jobs report, this following the slowdown in October after those labor market strikes and severe storms in the southeastern part of the US receded. Also, December 18th Fed meeting. Let's discuss why a 25 basis point cut has become widely expected to occur at that meeting in a couple weeks. And finally, we're nearing the end of the year. Magnificent stocks, the big tech companies have had a very strong year in our major earnings driver in 2025 as well. But let's just compare and contrast back in 2000 to some of those large tech companies. These companies are in much better financial shape and not as expensive too. All right, so we just received the November monthly jobless report this Friday, December 6th, and pretty strong overall. 227,000 new jobs. That was slightly higher than the estimate for 214,000. October was revised up 36,000 jobs, but was still relatively low. If you remember, October was impacted by the labor market strikes at the port and other areas, along with the severe hurricanes and multiple types of storms that impacted the southeastern part of the US. That really slowed down October. So it was good to see kind of a return to normal ahead of the holiday season. You probably saw some hiring as well, but we also saw September revised higher. Unemployment rate met expectations at 4.2%. We did see higher wage growth as well. Labor market participation slightly lower, so that's why that unemployment rate stays at 4.2%. Overall, job creation rebounded following that slowdown and shows that the labor market is still in pretty strong shape. And that's going to make the Fed more comfortable at their December 18 meeting, making that cut. We saw odds of about 70% of a 25 basis point cut ahead of the report. Those jumped more than 20%. We're just north of 90% probability based on Fed fund futures probabilities of the Fed cutting 25 basis point. Labor market strong, wage growth, economy's not showing any sort of cracks. Fed thinks that they're going to continue to push forward with that rate cut more likely than not. But if you look forward out over January and 2025, I think the Fed's starting to talk about, but maybe they'll start pausing. That's what the market thinks. The market only expecting two 25 basis point cuts in 2025 right now. That would put the Fed funds rate only down to 4% at the end of next year. A lot can happen between now and then, and those expectations are not as reliable looking out longer time frames. But right now, that is what the market's expecting. One rate cut in December and two rate cuts next year down to 4% by the end of 2025. Now, as we are near the end of very strong market for 2024, that's following obviously a strong market in 2023. But as we look to the earnings growth in 2025 for the S&P 500, still expected fundamentally to be pretty strong at 11.6% total growth in net income. And you can see sector by sector the contributors and the Mag 7, obviously not a sector within its own right, but the Mag 7 more than one third of the driver of the overall growth, 4.2% of that 11.6% is driven by the Mag 7. You can see utilities and financials, the only areas that are expected negative earnings growth. So a lot of concentration risk, if you will, on those Mag 7 stocks for us to meet those expectations now. So if those start to lag for whatever reason on an earnings front, that could have an outsized impact on the expected earnings for the overall stock market. Now, there's no doubt that the stock market is relatively expensive. There's no doubt that the Magnificent Seven stocks are even more expensive than the overall stock market. High concentration, but let's take a comparison of these seven stocks versus six of the top stocks, or the top seven stocks, if you will, tech bubble leaders back in 2000. And we're looking at different criteria in terms of percentage of market cap, the cash as a percentage of market cap, the 24 months, so the 2-year forward price to earnings ratio. So what is today's price divided by the earnings expected over the next 2 years, and the net profit margin. So a couple notes. Number one, you can see higher concentration, 31.3% of the index for the seven stocks today, only 19%, right? So it was not as concentrated back in the tech bubble. But if you look at every other metric, these companies have more cash on hand, some of that related to debt financing and putting cash during the tech or during COVID when interest rates have been very, very low. But they have a lot more cash, 4.2% versus 1.7, more than two times as much cash relative to their market cap. And valuations, while not cheap, 24 versus 52, not as expensive as we saw back there. Not as much mania across the tech sector. And then finally, net profit margin, significantly higher. These are cash cows. These are very profitable. Look at NVIDIA, 53% profit margin. So these are very fundamentally sound companies with very strong earnings. In some ways, they're earning their way to this high market cap. Valuations are elevated, but not the extreme that we saw back in the tech bubble as of right now. Now, finally, American malls, shopping malls, right? Those were popular 20, 30 years ago, and everybody knows that they're not as popular today. Some of the main, you think Macy's, J.C. Penney, Kohl's, these sort of flagship stores that are part of or connected to malls, these big American shopping malls are going away, but we're starting to see a trend of more and more real estate developers either knocking down the department stores to turn them into apartment buildings because we have a housing shortage in terms of supply across the US. You're even seeing some unique approaches of sort of mixing in apartments in old malls with remaining retail stores open. They had an example of somebody who was living near a Foot Locker and a TJ Maxx and the food courts and things like that. So I don't know if I'd want to live in a mall, but that's kind of an interesting approach. You're even seeing some short-term rentals like Airbnbs put in these things next to some of the remaining shops. So that's some, I kind of like the creativity. I think the apartment buildings make sense. I think it's a little bit difficult in terms of the redevelopment cost for those. So they're kind of navigating those on a case-by-case basis, but definitely a trend of American shopping malls that don't have many storefronts left, converting partially or entirely to bigger apartment buildings to fill that housing shortage. Interesting to see how the industry and economy changes and reacts to those supply and demand. So just something to watch and keep an eye on. With that, I want to thank everyone for watching and have a great weekend. I hope everybody had a great Thanksgiving and a great Christmas season. Christmas coming up, busy time of year for everybody. So thanks for watching. Have a great day.